everyone, a very good evening. You're watching The Money Show on ET Now. This is your daily dose of personal finance related news, views and opinions. Let me kickstart the show then by telling you what's on the menu today. First up, with the coronavirus crisis, there comes with it a set of problems with respect to money management, especially because many have faced job losses, income losses, and hence the amount of income coming into the household has reduced considerably, which means you cannot keep spending the way you did earlier. You have to choose. Either you continue with an SIP, continue either with an EMI or your premium payments. So how to decide on all of these tough options before you? We will be bringing on board Adhil Shetty of Bazaar, who's authored a great report on this very topic. And later on the show, we will also be talking about the topic of delisting. Vedanta, Adani Power, Hexaware. The commonality between these three shareholders is that the promoters have decided to take these companies private. What does it mean for you? We'll be bringing on board Anil Singhvi of ICANN Investment Advisors. But first up, let me introduce Adhil Shetty of Bazaar to talk on a report that they have recently released, the three toughest money management questions during the COVID crisis. Adhil, it's always a pleasure having you with us on ET Now and The Money Show. Thanks so much for joining us today. So Adhil, I suppose these are very relevant questions that you've brought forward in your report. First is MFs or bank accounts, and when I say bank accounts, obviously I'm talking about FDs. Second is pause SIPs or opt for the moratorium. Which one will help you get more money left in your hands? And finally, choose pay EMIs or pay insurance premium. All of these, unfortunately, are mutually exclusive and they're difficult choices that individuals have to make. So let's start off with the very first topic. Investing in mutual funds or removing all that money from mutual funds and putting it in bank FDs. Adhil, looking at the volatility in the markets and looking at how everyone's scam statements today are a sea of red, do you think that individuals should that's the reason why this question would be lingering in everyone's mind. Do you think that this would be a prudent option to sort of move their life savings to bank accounts from mutual funds?
Great question, Veena. It's a tough question, and a lot of people are asking themselves this question in the middle of COVID. So the Bazaar report gives them the tool that they need to answer the question for themselves. Now let's start with the choice between a fixed deposit or high yield savings account with a bank. Now this is very safe. No depositor has lost money with a commercial bank, and roughly these are giving between 5 and 6% interest, but these get taxed at the regular income tax rate. We took a example, and this was a tough choice. We said that assume you're invested in a liquid mutual fund. Now that's one of the lowest risk debt mutual funds possible. And let's assume that you're making 6%, which has been the last 1 year return on the liquid mutual funds. The choice we gave you is, should you stick with the liquid mutual fund or should you consider moving your life savings to a bank fixed deposit? Now, there's no really easy answer, but here are the 3 points the report throws out. So point number one, you will make 4% less if you break your liquid mutual fund after 2 years and move that money to a bank fixed deposit. You will make 4% less over a 3-year period or 1.3% less per year by making this switch from a liquid mutual fund to a bank fixed deposit, assuming both pay 6%. Now, the difference comes from the income tax treatment, because when you hold a debt mutual fund for over 3 years, it gets taxed as long-term capital gains, and that's how that 1.3% per annum delta comes. But the key takeaway we give the user to run with is you need to decide, is this 1.3% per annum worth my risk appetite or my peace of mind? Now, no one knows the right answer, right? Someone might say, no, I prefer to stick with my debt mutual fund. I prefer to make higher return. Someone might say that under no circumstances do I want my life savings to go under moratorium, and hence I want to move to a bank. So we've given you 3 easy tools. By shifting, you lose about 1.3% per annum. the differences from the tax treatment which we've calculated for you. And finally, the choice is yours. Is that 4% over 3 years worth it or not? You decide. It's a very tough choice.
Yeah, it's basically a very subjective thing, I mean, do you want to take that extra risk, which will also bring along with it that 1.3% extra return on an annual basis? Adil, let me just insert one more twist over here. Last week we were talking about how for senior citizens or for those individuals who are on the anvil of retirement, this is really a bad time, because just when you think that, okay, I'm all set to sort of crack in on my nest egg and, redeem all the profits through the savings that I've invested all my life, you've got COVID, and then boom, the corpus that you have right now has depleted in value. You may not be in a loss, of course, because since you're investing for your retirement, you've been investing long term, but the corpus value has gone down. For them, do you recommend they should move to the bank, to bank deposits and take that 1.3% hit, especially because they are on the anvil of retirement? So, do you think time horizon would have a lot to do over here as well?
Good question, Mubina, especially for senior folk, right? I think the choice between a liquid mutual fund, which is a very low risk debt mutual fund, or a fixed deposit, the choice is the 1.3% per annum, assuming you can hold over a 3-year period on the mutual fund. I think the other interesting question is, I actually find very strangely people who have a short-term requirement for money, like for example, someone saying, I'm going to retire in 1 year, or I need the money for a wedding in 1 year, who are actually in the market, I mean in equities, right? That we're saying is a big no-no. Now, equities make sense, and I encourage young people, if you're in an equity index fund, or if you have money today and you can wait for 5 years, as long as you can wait for 5 years, right, it's okay to be in the equity index fund. Over a 5-year period, the equity index fund will always do better than a fixed deposit post-tax. But if you don't have 5 years and you're a senior citizen, you need the money in 1 year, you need the money in 2 years, you should not be in equity to start with. You should move to a bank fixed deposit or high yield savings account if you need the money in a year's time. The choice between liquid mutual fund and a bank account that we spoke about, it's essentially the trade-off where you lose that 4% of your corpus. Especially if you're close to hitting that 3-year period on the debt mutual fund, wherein that benefit of the income tax kicks in. So that makes it a much tougher choice.
All right. Well, Adil, there's another tougher choice that you've helped viewers answer in your report, and that is, again, the same problem of falling short on cash, and you have an SIP going on, and you have your EMI payments as well. The income that you are getting currently is not enough to service both. But for SIPs as well, you have an option to sort of pause SIPs, and now the RBI has given you the option of even opting for a moratorium. When it comes to SIPs, a lot of investors and a lot of experts do say that, listen, an SIP is great because it gives you a chance to nibble into the markets even at low values. So you are getting more units at the same price, so on and so forth. But then, of course, you have EMIs as well to pay. So Adil, how would you recommend viewers go about making this choice?
See, if you have the money, obviously do both. That's an easy one, right? Pay your SIP, pay your EMI, and you're good. But let's deal with the tough choice. The moratorium is available now. You don't have to pay your EMI. But if you had to choose between pausing your SIP or paying your EMI in moratorium, what do you choose? I think the answer to that is straightforward. Pay your EMI. The reason I say that is you're paying interest on the loan, and that interest is growing your principal. If you have a choice, pausing SIP is a facility which is available. I'm not saying use it if you don't have to, but if you have to, pause your SIP. You can restart again in 3 months when your income comes back, but continue to pay the loan moratorium. In fact, right, let's push it one step further, Mubina. If you have a choice between selling your existing asset and paying your EMI in the moratorium, or holding on to the asset, what should you do? That's what the Bazaar report has tackled in tough question number 2. So what we're actually telling you is the following. Now, if you take a bank fixed deposit paying 6% today, your interest earned post-tax is about 4.2%, because you're paying, let's say, tax at that 30% bracket. Even if you invest in a liquid mutual fund, which is a low risk instrument, your take home on a 6% return is about 5.6%. Now, your home loan EMI is at 8%. Your personal loan EMI is over 10%, maybe 12, maybe 14, maybe 16%. Your credit card interest rate is even higher. So what we're suggesting is, even if you have to sell an existing asset, and again, I understand you could be making more by taking more risks. So maybe there is an instrument or an asset you own which is making 12, 14%, but you're not doing that risk free. If I consider risk-free instruments available today, you're taking home 5.6% on the liquid mutual fund, you're taking 4.2% post-tax on the fixed deposit. I think you're better off selling that asset and continuing to pay your EMI, because it's better not to accumulate that interest at 8% on the home loan or over 10% on the personal loan or even higher on the credit card. So even in the tough question of should you sell an asset and continue to pay your EMI during the moratorium, the tough question, we are recommending yes.
All right. Make sure you make your EMI payments. That's extremely important. But yeah, in a worst case scenario, you can take the moratorium. We'll be talking about Bank Bazaar's bounce back plan as well in just a bit. But before that, tough choice number 3, having to pay between an insurance premium or an EMI. Adhil, insurance has really attained a lot of importance amidst these times of uncertainties. You don't know what your income status is going to be. You don't know what your health status is going to be, and hence insurance. So Adhil, between these two options, how would you recommend viewers go about making their decisions?
Tough choice number 3, Mubina. Viewers have been asking us this, and we're forced to deal with these tough choices in this COVID situation. So what we're recommending, right, is during the moratorium period, which goes on till August 31st, as first priority, pay your insurance. I mean, your term insurance, your health insurance. Now, this is critical, right, because not having these could bankrupt your family, right? So if you fall sick, you don't have medical insurance, hospital expenses can be quite expensive. If you die for whatever reason, your family needs money, right? They need to have that term insurance to take care of themselves. So always prioritize your insurance premium. And especially since the RBI has given you the option or the benefit of the moratorium up to August 31st, pay your insurance as priority 1 and make use of the moratorium if you need to. Now, obviously, it goes without saying, if you can pay your insurance and you can pay your EMI during moratorium, do both. But if you can't do both, pay the insurance premium for term insurance and Mediclaim without fail. Now, you raised an interesting point. Even if you make use of the loan moratorium, remember, interest is accumulating. And depending on whether you're in the early stage of your loan, wherein the impact will be high, or you're in the end stage of your loan, your impact will be low. The report gives a calculation saying that if you're in the early stages of a 20-year home loan, by not paying 5 EMIs today, you might end up paying 30 EMIs more in terms of extended tenor at the end of the loan. All of this you need to calculate for yourself, and there are a lot of tools online, but we've done a sample calculation in the Bank Bazaar report. But the important thing, Mubina, like you pointed out, is we're giving you a simple bounce back plan. So we're saying make use of the moratorium if you have to, but pay back 1.2 times of the EMI you have skipped, paid back as a lump sum within 12 months. What that does is it crashes down and rationalizes your outstanding principal to what it would have been if you didn't make use of the moratorium. So it's a simple Bank Bazaar bounce back. If you have to make use of the moratorium, use it. Ideally, don't. But if you have to make use of it for whatever reason, make use of it. But 1.2 times of the EMI you didn't pay, pay it as one single bullet payment within 12 months and rationalize your EMI so that you don't pay any additional months at the end of the loan period. So that's the bounce back, Mubina.
All right. Okay, great. So there you have it. These are some of the toughest questions, that a lot of us have been facing, making choices between two important payments. And I hope Adil has helped you out with that, folks. Of course, if you have any questions and queries with respect to your personal finances, you can always email us on the Money Show at etnow.tv. And for now, of course, Bank Bazaar's report as well does provide a great draft on this. Adil, thanks so much for joining us today. Stay safe and stay healthy.